this week's episode of Coinscrum Markets. I'm Teana Baker-Taylor. Coming up, BlockFi's David Olsson returns to discuss the prevalence of Bitcoin ATMs across the globe. I'm joined by Sheeld Markets' Oliver Yates and Finery Tech's Ilia Drozdov to discuss crypto prime brokerage and market infrastructure in Europe in light of the recent MiCA regulations. And Crypto UK's Ian Taylor speaks to Charles Kerrigan from global law firm CMS to unpick the FCA's recent clampdown on crypto derivatives for the retail market. But first, let's take a look at this week's blockchain industry news. Markets hanging in a nervous state around this week's US elections, the crypto industry at least managed to pick up some support. Cynthia Loomis, the Republican representative from Wyoming and longtime Bitcoin fan, having first identified it as a potential future store of value way back in 2013, has been elected to represent the state for a 6-year term in the Senate. According to data analytics firm Skew, the Bitcoin futures markets, already buoyant from the recent increase in volatility, has also benefited from the uncertainty, with open interest on CME contracts reaching a near all-time high of $5.4 billion versus the $5.7 billion seen at the time of the halvening back in May, as traders look to position themselves for sharper moves ahead. Whilst Bitcoin has maintained its strength, with some analysts noting its decoupling from its correlation with tech stocks in recent weeks, the DeFi markets have continued their reversal from their summer highs. The perpetual DeFi futures contract, listed on crypto derivatives exchange FTX, which tracks a basket of the leading DeFi assets, has now seen a 60% reversal from its peak, with a similar contract on the Binance exchange falling by as much as 70%. With all eyes on the US election, the Brave browser reached a major milestone this week when it hit 20 million monthly users. Designed with crypto-supportive, privacy-preserving features and its own reward token from the beginning, the firm has seen a 230% increase in daily active users since this time last year, and claims to have an advertising click-through rate of 9% versus the industry average of 2%. And finally, the sharp reversal in the Bitcoin network's hash rate that we reported last week, which commentators have attributed to the end of the wet season in China, has continued and culminated in the second largest ever biweekly drop, falling just over 16% in a single adjustment. The sharp fall in the benchmark that automatically adjusts based on the amount of hash rate miners are contributing to the secure network will offer a 2-week boost to remaining miners, improving profitability that had been stretched to its limits by the recent rally to the all-time high. That's the news for this week. Make sure you remember to subscribe to our channel. Next up, Crypto RFQ. I'm delighted to have returning again this week, David Olsson from BlockFi. David, thanks so much for coming back.
Thank you, Teana. Pleasure to be here.
It's great to have you. We're going to get into a little bit of a deep dive into Bitcoin ATMs. But before we do, I just wanted to check in with you, given the election this week, lots going on in the geopolitical space, and seems to be having a bit of an impact in the lending market, and seems to have a bit of softening around the DeFi space. What's going on?
Yeah, always interesting. The election, we think at BlockFi obviously will be good for crypto, whichever way the election goes. Well, we think it'll be positive because the government still needs to spend a lot of money. Central banks still need to print a lot of money to get us out of this the COVID crisis. Yeah. So crypto is going to benefit from that, obviously, and especially Bitcoin. On the lending side of things, you're right. The DeFi craze has settled down a bit, and a bit of normalcy has returned to the market. So we saw ETH rates, borrow rates skyrocket over the last kind of couple months to actually above where dollar rates dollar lending rates were, which is pretty significant, which we hadn't seen before. And just people scrambling to get ETH from whatever corner back of the sofa, that they could. And now we're seeing that sort of trade unwind and wondering, what will be the next thing in terms of dollar rates. They've settled down a bit. The futures curve has flattened a bit as we headed into election and the volatility calmed down.
So the topic of the week, talking about Bitcoin, is Bitcoin ATMs. Just give us an overview. What exactly is a Bitcoin ATM for anyone who doesn't know?
Sure. Obviously, an ATM or cash point here in the UK is where we go to withdraw fiat currency. A Bitcoin ATM, on the other hand, is usually where someone would go to purchase cryptocurrency, predominantly Bitcoin. There are some kiosks that will also let you sell your Bitcoin online and then withdraw fiat, which is pretty cool. We are also seeing some of the altcoins get supported by some of the kiosks as well.
Okay, so moving toward crypto ATMs, not just Bitcoin ATMs,
Yes.
and moving from a vending machine to essentially more of an interactive buy and sell experience.
Yes.
Take us through how they work.
So we've actually enlisted one of our underwriters, Joe Chu, to be an intrepid Bitcoin ATM explorer. You'll see him here in the slides, or at least he's our hand model. So you can see him approach a Bitcoin ATM. We've had to, obviously blank out the name of the vendor. And then he's given a few choices. I think there's buy an e-gift card, donate to charity, and then buy Bitcoin. And so he selects buy Bitcoin, which then takes him into a disclaimer page. And he has to accept the disclaimers. And there's a number of them, like the quantity of funds that he can deposit in a day, the fact that he'll have to go through AML KYC procedures before receiving it, et cetera. He then inserts his fiat currency into the machine. The machine prints out a receipt that has a code on it. So when he goes home, he logs into a website that's on the receipt. He punches in his code. Then he has to go through AML KYC. And then finally, he gets his Bitcoin put into a wallet. And the Bitcoin will arrive, obviously, without certain fees that the ATM operator will take out. And those fees can range from 3 to 10%. So it's not
is that
most
AML
expensive.
KYC portion new to this experience, or has
So
that been there?
No, it is. So it is new. In the US, Bitcoin ATMs are regulated as money service businesses, so they have to have FinCEN regulation. Here, and that's a relatively new development, and the US has kind of been, ATM operators have been flexible in rolling that out. I think in the UK, the fact that the FCA has said that all companies dealing in cryptocurrencies or virtual currencies need to register with them has thrown some of the Bitcoin ATM operators for a loop.
Yeah.
And they're struggling, obviously, to get the infrastructure together to allow people to continue to use them.
Yeah, I can imagine. So where does one find a Bitcoin ATM? You mentioned the US, the UK. Are they prevalent?
Yeah. As you can see from the heat map that we've put together, they're predominantly in the US, almost 10,000 in North America, with 9,300 in the US. There's a few hundred in the UK, most of those in London. The most famous one it used to be in Bond Street, which just spontaneously started spitting out pound notes a couple years back and has since been removed. But they're growing in number, and we're seeing just the numbers of Bitcoin ATMs and cash points explode in the US and in Europe.
So who's using Bitcoin ATMs? Who's the target market for this service?
That's a really good question. The first people would be just those who are adventure seekers or looking for novelty and buying their first Bitcoin. But the vast majority, we believe, are people who are looking to remit funds back to their countries, which are probably in developing markets
Mhm.
where local currencies are probably not as stable and maybe have deflation versus, for example, U.S. dollar or pound or Bitcoin for that matter. So they're using it as a way to securely send money back home without having to go through kind of the loop, jump through hoops in terms of capital controls, which a lot of these countries would have. As well, they probably get a higher rate. What we've heard is there's a higher rate changing from cryptocurrency like Bitcoin to local currency than if they went through regulated channels and sending fiat like dollars and then converting into local currency.
Meaning it's more expensive for them or less expensive for them?
It's less expensive because the exchange rates for changing into from cryptocurrency to local currency are better, more in favor of the retail user.
Yeah, fantastic. Maybe we should try it. You and I can.
I think we should check if the bond street
Well, if
Bitcoin
it's giving
ATM
away
is
free
back.
money,
Yeah,
somebody
yeah.
should go. Yeah,
Yeah.
exactly. David, it's always a pleasure to have you. Thanks so much for coming back.
Likewise, thanks to you.
Take care. Improved market infrastructure that can support the growing institutional interest in crypto assets has been a hot topic this year, with a significant amount of investment flowing into companies building solutions. Until recently, much of that activity had been focused on the US, but with recent surveys indicating significant interest in building amongst asset managers in Europe, and with the European authorities due to push through their MiCA regulations by the end of next year, I spoke with Ilia Drozdov from Finery and Oliver Yates from Sheeld Market this week to talk about their prime brokerage and liquidity aggregation solutions and what the regulations will mean for them. I'm delighted to be joined today by Ilia Drozdov, co-founder of Finery and Oliver Yates, CEO of Sheeld Market. Gentlemen, thank you both so much for joining me today.
Happy to be here. Thanks, Teana.
Great, it's great to have you. So we're going to talk a little bit about the next wave of institutional crypto trading infrastructure in Europe. And just to set the scene a little bit, we've talked about institutional grade market infrastructure for crypto assets a fair bit this year, but a lot of that activity was based in the US, especially when looking at custody and prime brokerage. So Fidelity and in particular Cointelegraph's recent surveys suggest that professional interest for the asset class in Europe is real, and arguably in the case of the spot market is stronger than in the US. And on top of that, regulators have been picking up the pace in recent weeks with the EU's MiCA regulation due to come into force at the end of next year. And the FCA is also tightening up supposed retail protection for the UK. So we're thrilled today to have two founders from EU-based startups looking to tackle this challenge that may have possibly been holding back the broader institutional adoption for crypto assets. So I'd like to invite you both just to tell us a little bit about your companies and how you came about and what you're developing. So Ilia, let's start with you.
Thank you. So my co-founder and I, we have been working for an algorithmic trading hedge fund, namely high frequency trading. That's why we know what toxic flow is and how all this in industry works, right? Exactly. And in our solution, we wanted to design our platform network in a way that we can exclude this traffic, because we know how it badly impacts the bid-ask spreads that are provided by market makers. And we also know notoriously known wash trading in crypto industry and inflated reported volumes by the exchanges, and how it can be a headache for a buy-side firm to find the real liquidity in the crypto market. Given these two facts inputs, we've designed a platform that allows peer-to-peer trading between the participants. And we have two types of players: market makers, liquidity providers on one hand, and on the other hand, buy-side from hedge funds, corporations, even banks. And peer-to-peer means that the trading is disclosed. So you know with whom you trade, and you can customize spread, you can customize liquidity, and this is also compliant. So this is our flagship product that we're currently developing.
Great, thanks. Oliver, tell us about Shield Market.
So essentially, we're a EU-regulated prime broker for cryptocurrency. So what I mean by that is that we provide core services for buy-side firms, more specifically custody on one side, and then everything around execution and data and reporting on the other. So the idea is that we have accounts on dozens of exchanges and with several liquidity providers, and our customers can access all of that liquidity through one interface, API if you want, through us. And we really, the same as a regular, equities prime broker, we would provide low touch services like direct market access and smarter routing across these venues, and more high touch services as well, like a price treatment request for quotes for large block orders. And the goal here is we really want to handle the plumbing so that our customers can focus on their strategies and their business.
Fantastic. So Oliver, you mentioned that you're regulated. And Ilia, I wanted to just touch first before we get into that with you, considering that it sounds like you're taking a non-custodial approach to liquidity aggregation. So where do you guys currently sit from a regulatory perspective within the developing EU regulatory landscape? And specifically, what is MiCA going to mean for Finery and its clients?
So we're currently a non-regulated entity, and our final aim is to remain just a technology vendor. We create the technology that connects to different types of users, and probably most of them are regulated. Right now, like 90% of our users are regulated company. They have either registration or authorization from the local regulator in the UK, in the Netherlands, Switzerland, and a lot of companies from Estonia. But we as a company would like to live as a technology vendor, because we are non-custodial. We do not touch client funds. We just facilitate trading, facilitate communication, if you want. As of now, we have just a legal opinion from the local legal team, but the upcoming regulation and these markets and crypto assets regulation may change it. Especially, we might be recognized as a multilateral trading facility in these crypto assets. So we are currently preparing for this aim. But again, if we're speaking about crypto, the very idea of the crypto is that this is like people able to trade with one another without any middleman. And this is our idea. We would like to remove it. We'd like just to give them a tool so that they can reach their aims directly without any mediator in between.
Yeah, well, it'll be interesting to see how that unfolds. I know that Germany has been traditionally quite conservative when it comes to this, but there is that fine line between arranging for business and providing infrastructure facilities. Oliver, you pursued an approach that's a little more similar to traditional prime brokerage, and as you've said, you recently received regulatory authorization from France and the AMF. So under that model, that would be something that you would receive transitional arrangements into the MiCA framework. Can you tell us a little bit about what you've had to go through in France and what the interaction with the AMF was like? And do you think that the French regulation and soon the transposition into MiCA will finally tick those boxes for institutional clients?
Yeah, so for the first question, it's going to be quite fast for this one, the process. Currently, it's a 6-month process. The first part is, you get help from an external counsel because it's quite a difficult application. Generally takes about a month to get your application form done. Most of it is going to be around AML. As you can guess, we had to build a 200-page long booklet around our AML practices. And then you have operational processes, background checks on the company executives, things like that. We had to implement a bunch of internal controls, compliance controls, separations, just like you would in any brokerage or bank. So that's give or take a month, and then the rest, the 5 other months, are back and forth with the AMF. They have a bunch of questions, obviously, and you'll just amend your application along the way and add new things. So how did that interaction go? Well, the AMF was very supportive. The French government is bullish, generally speaking, around not just tokens or blockchain, but crypto, which is good for us. They're also quite educated on the topic, the different terms and the market structure.
Mm-hmm.
Now, they were quite tough, and also their questions generally went much further than what was legally required according to the law. So that was, I'd say, the most difficult part, is we actually had to give information that originally wasn't required, and it's luckily enough we were ready to answer them. But that, I'd say, it's quite a tough license to get. And third, final question: does it tick the boxes for institutions? I don't think it's that simple currently, because especially in France, but in Europe in general, a lot of these institutions rely on traditional banks as well for a lot of the operations, whether it's brokerage, whether it's for custody, just cash services or transfers. At some point, a bank is going to be involved, and banks, at least I can speak about the French banks, they're not currently comfortable with the level of AML that is required by the AMF for providers like us. So there is a spot where there's a bottleneck. So it's not that simple. It helps things move forward, but most institutions are going to wait for banks to validate these, the flows in the AML processes to move forward.
Yeah, you raised an interesting point about the scope of information kind of expanding. And I always wonder, is that the balance between, regulators kind of learning sometimes in real time, or if they actually are kind of pushing the boundaries around what information they're obtaining from firms. So, I think that whilst regulation could and hopefully should help to bring in new liquidity, the EU specifically seems to be moving quite quickly. I think from the outside, if you haven't been involved in consultations and the policy development space, this might seem like it's coming quite quickly. So outside of the familiar looking solutions that each of you are working on, how do you think that these developing regulatory policies could affect things like DeFi? And do you think that they're helping to inhibit or encourage innovation?
I do hope that the regulator and overall legislation bodies in Europe are advanced and innovative enough in order to foster further development of the decentralized finance. The idea here is that you allow people to interact with one another directly, and it is possible right now. And the fact that some bad guys using these for money laundering purposes, for example, doesn't make the technology, the underlying technology or the underlying idea bad, right? Say, all these regulation around crypto custody sounds a bit odd to me, because the blockchain itself allows anyone to have your asset on the blockchain, control it without anyone else. And if there is a custodian that has control over your funds, in which way is it different from the legacy traditional financial system? So this is the question. And if the regulator comes here and tells us that if you'd like to store any kind of blockchain, crypto, or tokenized asset, you have to do it with a regulated body, it will be actually the same that we have right now. So what is the innovation here? How will it help us remove the legacy here to speed up the process? I don't know. But still, this is still the open question. And actually the guidelines that have been published by the European Commission about this MiCA regulation, they are, at least to me, they sound promising. So they are not really strict as, for example, the BaFin approach in Germany. They just considered all the cryptocurrencies a financial instrument, or Bitcoin as a financial instrument of a new kind. This is something else. And a personalized approach is required here. So I do hope that here in Europe we will end up with some light version of regulation that will foster innovation rather than have an additional burden on startups.
Great, Oliver, what's your take?
Yeah, so my take on this, I'd say there's 4 main points in the MiCA consultation that could be problematic for DeFi. The first one is implementation of the travel rule. Without going into detail on how it works, essentially right now for traditional assets and for banking transfers, there is a common central repository with files that gives information on the ultimate beneficiary of the transaction. And this works because everybody works under the same format. But right now, no DeFi project has been using a common or typical format to share information. Actually, most DeFi projects don't share any form of KYC information. And so if travel rule is enforced for anything related to crypto and DeFi, no protocol will be able to interact with another, because at no point will that information be able to be passed along correctly. That's one issue I see. The second one is the issue around stablecoins. They're going to require some pretty heavy rules and requirements, especially in terms of capital for people wanting to issue stablecoins in the EU. And that's going to be difficult if you want to launch a new innovative project. If it's going to die the next day just because there's no way it goes through those initial requirements, all we're going to see are government-backed initiatives, and that's nice, but there aren't going to be many, and they're going to be slow. And it's important for private projects to get through, to get innovation further along. Third thing is, if you have to do KYC on occasional customers, all of them are just going to go on other exchanges, right, or other brokerages. It's just they're not going to stay and go to European platforms. And then the fourth one is, for example, in France, we're registered, but they also had an optional plan, which they call the agreement, l'agrément. And we're the fourth company to get registered. No company has asked for or gotten the agreement. It's way too difficult to get. And if this is adopted EU-wide, the barrier to entry to get these types of licenses is going to be way too difficult for incumbents. That's just going to leave it to banks, and who knows if they're going to move in the crypto space. So,
Exactly.
4 points. Yeah.
Absolutely. No, I think you've summed up the key challenges there quite well. So let's take a look at each of your products. You're both at early stage, and no doubt face the perennial challenge for models that are setting up, the wheels of motion and the catch-22 of attracting liquidity makers to satisfy the liquidity takers, and vice versa. So how are each of you tackling this issue? And how does a typical conversation go when speaking with prospective clients who are looking to enter this market? Ilia, let's start with you.
Okay. So we have been happy enough to have a pilot market maker, and probably without these guys, we wouldn't start. So from the first day, we had a pilot market maker, pilot client, pilot market taker, in order to start having traction from the very beginning. And this market maker is just not so popular firm called Veliona, a Cyprus-based proprietary trading firm, but they are good enough to show quite competitive prices, at least in contrast, in comparison to centralized exchanges, such as Kraken, which is the leader in BTC Euro liquidity. Thus, when we are speaking to potential takers joining our platform, the main advantage that they will get by joining our network is that they will benefit from better prices. And there is some statistics that show that this is the result of it. And I guess this is not the fact that Kraken is worse than the technology that we have built. This is just the way that Kraken is anonymous trading and we are disclosed trading, and we makes it possible to to include toxic flow, to customize spreads better for the clients at the end of the day. And the second point here is that we're non-custodial, so there is ability to trade within the credit limit, counterparty limit, and there is no need to send some fiat. Which is not possible during weekends or public holidays. And if there is a need to hedge your exposure, you will be able to do it on our network.
Oliver, I'm gonna elaborate on the question a little bit more for you. Looking over the past year, how have you seen that institutional interest or demand, increase? If it has indeed, is Cointelegraph accurate in their survey? And coming from that prime brokerage space, often there are elements of trust and balance sheet confidence that are typically kind of the main challenges or barriers to growth. Are you experiencing those, or is the interest exceeding that barrier?
One of my co-founders, Jacques, is the guy who built and managed Crossfinder, which is Credit Suisse's dark pool for equities, and it's one of the largest, if not the largest, cash equity dark pool in the world. And so that helps as well when we're talking, the network that he has, and also the expertise, the way we manage the platform. A lot of it is the best practice from prime brokers and some of the largest banks. Balance sheet is another issue, obviously. Some stuff you just can't do if you're not able to take on the risk. And I think the key concept here is don't try to, how could I put it in English, take too much or eat too much at one time. Just, evaluate whatever risk you can reasonably take and focus on that. You're not going to compete with an entity that has $100 million balance sheet that they're able to deploy across the place. You're not going to be able to compete with that. But there's some other stuff on which you can compete. I mean, crypto trading operations are quite tough. It's not just about forwarding or pre-funding accounts, but rebalancing, managing spreads, things like that. If you can make those things simpler, those don't necessarily require a balance sheet. They require experience in finance in general. And do institutions respond to this? For the moment, that most institutions aren't entering the space. As we all know, the famous institutions are coming. It hasn't been happening a lot. But from what I've seen, they don't necessarily always focus on balance sheet. Are we able to take on the risk immediately? That they have other issues around custody or, facing a regulated counterpart, things like that.
Fantastic. Gentlemen, it was great to have you with us today. Thank you so much for the fascinating chat. I wish you both very well. And we'll have you back in a few months and see how you've been getting on.
Thank you for that, Teana. Thanks, Ilia.
With regulators globally tightening their grip on crypto trading venues and following a year-long consultation, the UK's FCA recently announced its new policy banning the offering of derivative products that track crypto assets to UK-based retail investors and traders. Ian Taylor, chair of industry trade body Crypto UK, was joined this week by Charles Kerrigan from the global law firm CMS to discuss its implications and possible unintended consequences.
Thank you very much, Teana. Hello, everyone. Welcome to today's segment, covering all things policy and regulation. And today we're going to focus on the recent announcement from the FCA prohibiting the sale to retail clients of investment products that reference crypto assets, specifically covering derivatives and ETMs, known as exchange-traded notes. Before we dive into what this means, let me make an introduction to Charles Kerrigan, a partner and global fintech lead at CMS. Good afternoon, Charles.
Hi, Ian. Thanks for having me.
Most welcome. Would you like to give a brief introduction of yourself and what you do at CMS?
Yeah, thanks. So CMS is a big law firm. That means I'm a lawyer and I'm a fintech and deep technology lawyer. So I work on kind of frontier technology projects in blockchain, artificial intelligence. That takes me into mainstream projects in the conventional financial markets and also into crypto and all of the developing projects that we see going on in that world.
So as we've seen recently, the FCA issued a wholesale prohibition of derivatives and exchange traded notes. And just for our audience, derivatives are products that reference an underlying, so we can have a future or a swap or a forward that references a crypto asset. Whereas an exchange traded note, it operates like a bond, so it basically has a maturity date and is backed by the issuer, so you're exposed to credit risk there, which is slightly different to an ETF, which we don't have any ETFs for crypto yet, but there's a lot of work going on in the US around that. But in regards exchange trade notes, to just quote one that trades on Deutsche Börse's Extra in Frankfurt, there is a regulated BTC, etc., Bitcoin exchange traded crypto ETN on a regulated market that has central clearing. So there are developments in the space, but just really to dive into what this means for the UK, Charles, if you could just generally talk about what this ban is and your sort of sense of your experiences or why this has come from the FCA and now.
Sure. So as you say, the FCA is our regulator in the UK for financial products and activities. And the regulation looks at two things: activities and investments. So what do we mean by that? Activities means things like marketing, selling, investing, and investments, given examples there, derivatives and ETNs are examples, and of course stocks and bonds are examples as well. So the definition of investments is only limited by the ingenuity of market participants, and the regulator's role here is to do a couple of things. Ensure an orderly market would be one. Ensure authorization for market participants. So if you're a business that is entering into activities in relation to investments, and you'd likely need an authorization from the FCA, they take some time and money to get. We might touch on that later. And what the FCA is concerned about here is consumer protection. It also has a remit to ensure that customers are treated fairly and are protected, so not in a position where they could be exposed to unreasonable losses. And that's where this regulation comes from. So the ban on derivatives and ETNs in relation to crypto comes from, I think, fairly clearly consumer protection motivation at the regulator. I think we're going to go on to industry views around it. I think it's worth just noting at this stage that we are broadly consistent with the regulators in the US in this respect. And the FCA isn't saying that it's got a problem with crypto. Its report from earlier this year around summer was pretty positive. So it had done research and noted the fact that adoption in crypto is well up in where it was in the last report, 2018. And I think more notably that users, holders of crypto, are pretty clear that this is a risky investment. So what they didn't find was that there were a lot of people who were investing into this market and thinking that it was a safe market, that they weren't particularly exposed. So we're reflecting here the position of the regulator. It's picking up the pieces. So if this blows up, then the consumers will look to the regulator and say, why were we not protected? That's part of your remit. The politicians will do the same thing. And it's a fast-moving market at the best of times. And I think the FCA is just concerned about the potential exposure that customers have got in this area.
Thank you. And just moving on from that, I noted from the policy release when I read it a couple of weeks ago that 97%, so almost every single response they had, and they had dozens and dozens of industry responses, were against a complete ban. There were a number of suggestions. I was involved in one response where perhaps we could look to other similar areas such as CFDs, where there isn't a complete ban for retail. There's a ceiling for the amount of leverage. Can you give a sense of your experience from clients you've been talking to in the industry at large as to what the view is regarding a wholesale ban?
Yeah, so I'd say the view depends a little bit on how you define the industry that we're talking about here. So if you're thinking about the industry in the broadest terms, financial services, that's a relatively conservative industry. And I think there is a degree of support for the ban, and people in that market probably weren't among the responders. Fintech, there would be more open-mindedness, and crypto for sure. My experience is the same as yours, that these are people who are in the market. From their perspective, these are valuable products that they can use as part of a trading strategy, and therefore there's for sure a degree of disappointment that people wouldn't be able to access those trading products and strategies that they've currently been using. I think also if you look at the industry from the perspective of the providers of the products, then they're going to lose business. So this is something that they've been able to provide to customers. They won't be able to in the future. On the other hand, still within crypto, I think that there is an institutional element to the market that is less focused on derivatives and more focused on adoption. So digital assets and crypto being assets that are more widely traded and part of more conventional trading portfolios. And they're not well represented amongst the respondents, but certainly in my experience, the key from that perspective is not to have this blow up before we've got to full adoption, to try and make this a broad market that has more users rather than a narrow market that focuses on those sophisticated users that want to use these products.
Yeah, that makes sense. And I always think to myself, as a regulator, as you mentioned, your remit is to protect the consumer, and we wouldn't want hundreds of millions of consumer money being wiped away because of the lack of understanding and a lack of knowledge around what is a complex product. And that feeds me nicely into the next question with regards to the reasons that the FCA had given for the ban. And we noted from the policy statement released in mid-October that the main focus was regarding the twin concerns of the volatility of the underlying asset class, Bitcoin, for example, and the valuation of the crypto asset. Can you discuss in slightly more detail around these two aspects, what these risks represent and why the FCA focused specifically on these two?
It's a good question because, ironically, we wouldn't normally expect to see a regulator arguing against derivatives. So I think it reveals between the lines an interesting point here. When the FCA looks at derivatives in its general market remits, that's a relatively boring market with CFOs managing their interest rate and foreign currency exposure. So from the regulator's perspective, derivatives are a tool to manage down the risk of volatility. So we're in a parallel world here. How do we find ourselves, as you say, with this feedback from the regulator, which is almost the polar opposite of what you'd expect them to say in a more conventional market? And I think the numbers that we see tell the story of that the support for crypto derivatives is particularly underpinned by leverage. So you can use derivatives to achieve two aims. You can hedge away your risk, reduce your risk, or you can magnify your risk by using leverage. And the risk of derivatives in all markets, this isn't just crypto, is that they allow larger trades to be made and therefore the potential for larger losses. And I think that is what the regulator is concerned about, that we're seeing the spot market, the holding of crypto being a relatively smaller market when compared to the potential exposures in the derivatives market. So I think the regulator is putting two and two together there and saying that in this case, derivatives are not being used as a tool to manage risk, they're being used as a tool to magnify risk. And if we put that alongside, there is a perception, although I think maybe you and I would say that that is becoming more out of date, that these are volatile assets at the best of times. So if you're multiplying risk and exposure in relation to already volatile assets, then that is the kind of thing that would concern a regulator.
So that's interesting to hear. And so if I just could come to my final question, if I may, just with regards to what firms and individuals can do, if they believe they understand the risks, as I'm sure many users of crypto right now in the retail space do, what can they do if they still want to use the crypto derivative as a hedge, for example, which is one of the major reasons of having derivatives?
Yeah, sure. So I think it's worth bearing in mind that this is a ban on retail sales. So for a professional investor, if you are characterized as a professional investor, then the ban doesn't apply to you. You're still able to enter into the markets. And I think that is part of the regulator wrestling with this distinction of what is a sophisticated investor for these purposes, because traditionally a professional investor is defined by reference to, they may be a firm, a trading desk at a firm, or they might be someone who is particularly sophisticated, experienced, or just has a level of assets that means that they can be judged to have a level of sort of special knowledge and are less exposed to losing money that they can't afford to lose. So there is still that position there. I think we have still a bit of thinking to do from the regulatory perspective of how do you define a professional investor, because here there are, as you I think reference, some folks out there who are extremely sophisticated and trade high volumes, but not necessarily easy to fit within the traditional category of a professional investor. And I think that's part of where this market is still finding its feet, that the regulators come from quite traditional perspectives. And the crypto assets, I think when we look at it from a broader regulatory perspective, we've got cryptocurrencies on one hand, we've got digital assets on the other hand, and by digital assets there I mean tokenized versions of traditional assets, so a tokenized share, tokenized bond. There's pretty fast adoption coming through in that market, and the regulator's pretty supportive there. So they're making distinctions here all the time that are fine and judgment calls. They do make the point, I've referenced professional investors here in their published rules in this area. They've added an anti-avoidance provision and told market participants not to game the rules. So don't just recharacterize all of your retail investors as professional investors and carry on. So it is going to be tested and checked. I think they're probably also looking from the perspective that we've had some positive stories of large corporates moving some of their cash holdings into Bitcoin in particular. And I think if I were the regulator, I might note the fact that those large, sophisticated corporates with deep pockets moving into crypto, but they're just buying the asset. I think they are treating that as risk enough without taking leveraged positions in relation to the crypto. So I think it's always the story with these sort of innovations and how regulators face up to them. It's incremental change, and I think here the story of this is the regulator has identified what it thinks is a risk because of the value of derivatives. It's not necessarily a problem with derivatives themselves. So that exposure reflected in the value and volume of the numbers is what's concerning them. As adoption continues, cryptocurrencies become more widely used. We see platforms, the PayPal news is big news in this area. So I think we are moving our way. We might have 2 steps forward and 1 back, but then we'll have another couple of steps forward. So it doesn't change my view in any way of where this market's going.
No, and same here. I totally agree with you. We saw the PayPal announcement the other week, which was positive on the price of Bitcoin, not to mention a number of firms increasing their balance sheet holdings of alternative assets such as Bitcoin. All right, well, I would like to thank you so much, Charles, for joining us today on Coinscrum. If anybody wants to reach out to yourself for any advice in the interesting work you're doing, where can they contact you?
I'm on the CMS website and I'm on LinkedIn, so I shouldn't be hard to find. And very happy to hear from people. We've got lots of clients across the firm, UK and Europe, who are crypto businesses and service providers to crypto businesses. Would love to hear from more. It's something that we've spent a lot of time and effort supporting. So I'm grateful for you to give me the chance to come and talk to you about it.
Not at all. Appreciate you being here. Thank you very much. And now back to Teana.
You've been watching Coinscrum Markets. Thanks for joining us. See you next week.